folks, Andrew Lockwood here from the City Traders. So 2022 is drawing to a close, and boy, what a year it's been on the financial markets. Now the US dollar is closing the year with just a 12% gain, having been up over 20% at one point. Now global stock markets, they've been smacked all across the globe. The S&P 500 was down as much as 27% at one point. I think it's ending the year now at the time of recording with just a 15% loss, so a bit of a recovery going on there. Oil prices, they've been up 75% this year, coming back now of course, but a massive move, ending the year with just a 10% gain, which is pretty much unchanged, I guess, if you consider it, for the price of oil. Then you've got to look at Bitcoin. Bitcoin, don't get me started on Bitcoin. That's shed 75% this year. Now we're seeing Facebook, Meta shares doing almost pretty much the same. It has been a turbulent year on the financial markets. So what's been causing all this turbulence, I hear you cry? Well, basically it's twofold. Clearly we've had the global pandemic and the lockdown across the world. Now we're seeing the re-emergence of the economies, it's leading to supply chain issues and so forth, all pushing prices higher. It's all about inflation. Then you had the Russian invasion of Ukraine, which is basically causing energy prices to surge, again affecting inflation. So 2022 is basically a story about inflation, the cost of goods and services flying higher. Got 11% here in the UK, you've got 8% in the US, other developed nations pretty similar. You know, central banks, they're mandated to keep inflation around 2%. And one of the reasons, or one of the ways they do that is, of course, moving interest rates. And consequently, interest rates across the globe have been surging higher. So economies around the world are having ripple effects with these surging inflation and indeed interest rates. So what's in store for 2023? Well, that's what we're here for, I guess. Let's have a look at the charts and see what's about. Okay, so here at the City Traders, I generally focus on Forex, the currency markets. Do trade indices and cryptos and commodities as well, but Forex is my main focus. Now, I wouldn't be able to trade the Forex market on an intraday basis without looking at the chart you see here on the screen. I call this the momentum meter. I had it coded for me almost I don't know, maybe 10 years ago, and there are versions out there. It's basically a currency strength meter. It tells me what currencies are strong and what currencies are weak. And of course, you can set this to the different time periods that you are focusing on. What I've got here on the screen at the moment is basically the monthly chart. So it basically shows us what the currencies have been doing over the last few months. You can see back here, follow my crosshairs, back from basically February 21, the green line, that is the US dollar. I coloured it green because it's referencing the greenback. You can see here the US dollar has been on a steady incline pretty much for the last couple of years. So that has been the strongest currency in the basket of 8. Now, normally what happens in the currency markets is when the US dollar gets strong, the euro tends to get weak because it is the most actively traded currency pair on the planet. When you trade a currency transaction, there's two transactions going on. You're buying one and you're selling the other. And you see here the light blue line. This is the euro. So you can see the euro has been on a steady decline at the same time where the US dollar was inclining. You see here the British pound. British pound has been absolutely smacked over the last year in particular, pretty much since the beginning of this year. You see where my crosshairs here. This is basically January the 3rd, 2022. The white line, British pound. Pound has been in a decline, and you may have seen pound got down to a low of 1.03 when we had 42 days of chaos with the Liz Truss new government. That's basically when we hit the lows back down there. Didn't last for very long. Pound now, as you can see here, is up on recovery. But what's interesting to note here is that the US dollar is now pulling back. It now seems to have hit the highs, and that maybe will be the focus that I'll be focusing on next year. I'll talk about that in more detail in a moment. I just want to explain to you briefly why the US dollar has been so strong. This chart here basically shows us the bond yields, global bond yields. As I said to you on the intro there, currency markets are all focused on interest rates which focus on inflation. Interest rates are a tool that the central bankers use in order to control inflation. And you see here at the top here, the US 10-year interest rates are currently, at the time of recording, at 3.75%. And you've got here the DE, this is basically the German interest rate market, down there at 1.9. So you can see there's a big differential. And as interest rates fall, the currencies should normally fall as well. You see here, the US interest rates have been falling. They've been falling pretty much since the whole of November. And because of that, that is why the US dollar is declining. And there's a real strong possibility that interest rates will peak again next year in 2023, which is again why the US dollar may come under pressure. One thing I also want to show you is this currency down here, the JPY, Japanese yen. Interest rates are stuck there. They are basically at 0.25%. The central bank, the Bank of Japan, not going to move interest rates in Japan at any time at the moment. So there's been a big trade in buying the US dollar for the higher yield and consequently selling the Japanese yen. That also now seems to have been fading. There's been a big trade. It's called a carry trade, where traders are trying to invest in the higher yielding currencies to get a return, and they're of course selling the low yielding currencies. So if you look here at the dollar against the Japanese yen, you can see that the US dollar has been on a massive run to the upside. This is basically meaning that the Japanese yen currency has been weakening. Now, the Bank of Japan have been pretty active in the last month or so, intervening in the currency to support the Japanese currency. Of course, they don't want an ever decreasing currency, so they've been visible in the markets actually buying the Japanese yen. They actually started that at around the 145 level, around this level here. Again, if you follow my crosshairs, that's when they basically started buying that. And you can actually see that if you go down to the daily chart here. You'll see exactly what happened. It was around the, I think it was around the 22nd of September. You'll see this big move. It moved from 145 all the way down to 140 in the space of just one trading day. There it is there, as the Bank of Japan intervened in the market. When we got up to 152, they intervened yet again. So you can see there, that's why it led to that big sell-off in the dollar against the Japanese yen, because the yen was being bought. And that seems to have had an effect. The dollar against the Japanese yen is now poised at a very important level, at 139 basically at the time of recording. There is price action in here to maybe lend a school of thought that this currency pair now is in for a retracement lower. The Bank of Japan has been obviously sold off because of low interest rates. If interest rates in the US start to peak next year, you're going to see a rewind of that big trade, the buying of the dollar and the selling of the yen. And that indeed could take us right the way back down to, I would say, something in the region of 50% of this year's move. This year's move really started from about here, around the 116. Getting out my drawing tool here, you'll see 50% of that move could take us all the way back down to 133 for the next test. So I think that is pretty much on the cards. If we break the 133 level in the dollar against the Japanese yen, then you can expect to see the yen retrace all the way back down, potentially to 114. Again, this is more of an interest rate play as well. When that currency pair was hitting those dizzy heights at 152, it was the carry trade. And there is evidence now that that carry trade is unwinding. Of course, we have to know where interest rates are going in the US before we can safely call that. Which brings me on to the next fundamental point. Interest rates in the US are, of course, the leader of all interest rate markets. Whatever the US does, the rest of the world tends to follow. Now, recently, the Fed have indicated, certainly at the minutes of their last meeting, that they will now be slowing down the paces of their rate hikes. The last 4 months, they've raised rates 4 times 75 basis points. There's talk now that they are going to reduce that down to 50 basis points and possibly even 25 basis points in the subsequent meetings into next year. Once the market starts to believe that the Fed has reached its peak, you're going to see a further unwind of this dollar-yen trade, which is why I think that would be a trade for this year. For next year, could be a bit of a leader for you. The other currency pair I want to look at is the pound against the Japanese yen. Let me just put up that screen now. So this is the pound against the US dollar on the daily chart. Now, as I said, we hit the low there of 103 back with the shambolic 42 days of the Truss government. But if you look at where the pound has been pretty much since the end of last year to the low, the 103 low, and I'll do that by taking on my drawing tool here, you can see that a 50% retracement of that level takes us almost exactly to where we pulled off just a few days ago at the time of writing. Again, looking at the chart here, you will see that this has been a support zone. Often support turns into resistance. When we did break through, we retested and then we went down and took a new low out. What I'm looking at for next year, and one of my trades for the longer term play, would be a rebound for the pound against the US dollar as the US dollar pivots away from the high interest rates. Okay, so we've got this level here at 122. This is going to be a crucial level for next year. We're ways away from it at the moment, only about 200 pips in fact now, but this is the level that I expect to be the support zone for the pound running into next year. So pound basically breaking higher than 122. It will then act as support as the dollar depreciates lower. So this is the level that I think will be crucial for next year. Now, of course, if I'm completely wrong and the US dollar puts on fresh highs, then you can see this maybe back down to the, I don't know, maybe the 110, 115 level. But I think into 2022, the bias is for the weaker US dollar as interest rates tend to pivot lower, and then the pullback you see in the other currencies more likely to prevail. So I'm looking at that in particular. It's been trading nicely at the moment with all these higher lows and higher highs. Definitely momentum is with the pound. So back finally to the momentum meter. I just want to show you exactly what we are now looking at on the lower time frame charts and why this chart is so important. Now, at the time of recording, there's pretty much in the news at the moment about China opening up from its COVID lockdown story, the zero COVID strict policy that they've had there since the outbreak of COVID. Now, there does seem to be an unwind of that rhetoric. The authorities are making signs that maybe that is coming to an end. Now, we don't know exactly when it will happen, but it sure as will happen at some point, I think, into 2023. And what you're seeing at the moment on the charts is a reflection of that in the commodity currencies. I want to point out to you here the Australian dollar, the orange line, the New Zealand dollar, that is the grey line. But look down here, this is the Canadian dollar, the purple line. All these currencies are heading in the northerly direction. All these currencies are benefiting now from this China story. And this China story is only likely to accelerate into next year. So if you're looking to take advantage of that story, then maybe look to buy these commodity currencies. In particular, I'm looking at the Canadian dollar this for the end of this year and into next year as well. Canadian dollar is heavily linked to the price of oil. I mentioned there on my intro there, oil has basically risen 75% this year to the high. And we've had a pullback now of about 20% from those. But now oil does appear to be finding a base. If China, if the global economies continue to open up, China in particular, then you can only expect the price of oil to continue higher, in which case the Canadian dollar, which is heavily correlated to the price of oil, will trade higher as well into next year. So if you're looking for an edge in the markets, maybe look for those commodity currencies to trade against the US dollar as well as we open up. That's my brief look at the currency markets and my view for 2023, in particular looking at the pound against the dollar, and of course the dollar against the Japanese yen. Okay, so I hope you found that useful. I really do like talking about these currency markets here, the 8-cap trade zone. I'm looking forward to more in 2023, so stay tuned.